The money sitting in your bank account doesn't exist in the way most people think it does. That's not a metaphor, and it's not conspiracy theory. If everyone tried to withdraw their cash at the same time, the banking system would collapse almost instantly because the money simply isn't there. This isn't a flaw in the system, it is the system. Fractional banking is the quiet engine behind modern money, debt, inflation, and the illusion of wealth. Once you understand how it works, you realize that most money today is built on promises that can never all be fulfilled at once. To understand where this began, we need to go back before digital balances and mobile apps, to a time when money was physical. In medieval Europe, wealth meant gold and silver. If you were rich, you had coins in chests or jewelry you could trade. But carrying gold was dangerous, so people began storing their valuables with goldsmiths, men who owned strong vaults. In return, the goldsmith issued a receipt promising the bearer could reclaim their gold at any time. These receipts were simple claims, but they quickly became more useful than the gold itself. People realized they could trade the paper instead of hauling heavy metal. The receipt was lighter, easier, and widely trusted. That's when the trick was discovered. Goldsmiths noticed something crucial. Depositors almost never showed up all at once. Out of 100 clients, maybe 1 or 2 would demand their gold on a given day. Most of it just sat there. So goldsmiths began issuing more receipts than the gold they actually held. If they had 1,000 coins in the vault, they might issue 2,000 claims. Those extra claims were loaned out at interest. As long as confidence held, no one noticed. On paper, wealth had doubled. In reality, nothing new had been created, except debt. This practice was revolutionary. The moment people accepted claims as equivalent to real money, money creation became detached from physical reality. Banking emerged from this logic and formalized it. By the late 17th century, governments embraced the system themselves. The Bank of England was founded in 1694 not as a public service, but to fund war. The crown needed money it didn't have. The bank created credit, lent it to the government, and was repaid with future taxes. Ordinary citizens paid interest on money that had been created out of nothing. This model spread everywhere. Early American banks did the same thing. They issued notes redeemable in gold, but printed far more notes than gold in their vaults. Periodically, reality broke through in the form of bank runs, panicked crowds demanding their money and discovering it wasn't there. Banks collapsed overnight, but instead of abolishing the system, governments reinforced it by creating central banks. The message was clear. Even if the money isn't real in a physical sense, the state will protect the belief that it is. In modern terms, fractional banking works like this. You deposit $100 into a bank. You assume it sits there untouched, waiting for you. In reality, the bank keeps only a fraction and lends the rest. Historically, that fraction might have been 10%. Your $90 gets loaned out, spent, and redeposited elsewhere. That deposit is then mostly loaned again. By the end of the cycle, your original $100 has multiplied into nearly $1,000 of credit circulating in the economy. But only a small portion exists as actual cash. The rest is debt. And here's the part most people don't know. In the United States today, banks are no longer required to hold any reserves at all. Since March 2020, reserve requirements have been set to 0. That means banks don't need deposits first to lend. Instead, they create loans first, which then create deposits. When you get a mortgage, the bank doesn't hand you money from a vault. It types new numbers into your account. That money exists because you promised to pay it back. So what limits lending now? Not reserves, but regulation. The modern constraint comes from global rules known as the Basel Framework, written by central bankers and regulators meeting at the Bank for International Settlements in Switzerland. These rules require banks to hold a certain amount of capital, their own money, to absorb losses and enough liquid assets to survive short-term shocks. If a loan is risky, the bank must hold more capital against it. That's the leash. But the key point remains. Money is created through lending, not saved first and loaned later. As a result, more than 90% of the money in circulation today is not cash or central bank money, it is bank-created money, credit born as debt. Every dollar appears alongside an obligation to repay it with interest. This design has unavoidable consequences. First, inflation. When banks continuously expand credit, the purchasing power of money erodes. Prices rise not just because of supply and demand, but because the currency itself is diluted. Second, perpetual debt. Since money enters the system as a loan, there is always more debt available to repay it. Interest ensures that the balance never fully closes. Someone must default, refinance, or borrow more. Third, concentration of power. Banks collect interest on money they create. Governments rely on this system to fund spending without explicit taxation, and asset owners benefit as inflation pushes up the price of real estate and stocks while wages lag behind. When confidence breaks, the illusion shatters. In 1929, banks had multiplied credit far beyond reality, fueling a stock market bubble. When panic hit, the money vanished. Thousands of banks failed. In 2008, the same mechanism reappeared through mortgages and complex financial products. Credit expanded, risk was hidden, and when defaults spread, the system nearly collapsed. Each time, governments and central banks intervened, injecting massive liquidity to keep the structure standing. The trick was preserved because without it, modern economies would seize up. Here's the uncomfortable truth. The system cannot survive without debt. If everyone paid off their loans tomorrow, the money supply would shrink dramatically. Economic activity would stall. You are not just a participant, you are the fuel. The system depends on your borrowing, spending, and belief that the numbers on a screen represent something solid. So what's the lesson? First, money is not wealth. Real wealth is productive assets, skills, knowledge, and independence, things that exist outside fragile promises. Second, debt is not neutral. It is the bloodstream of a system designed to benefit lenders and asset holders. Third, inflation is not a mistake. It is built into the design. This isn't a call for panic, it's a call to awareness. Once you understand the trick, you can begin to protect yourself from it. Ignore it, and you remain trapped in a system where the house always wins. History doesn't repeat, but it does rhyme, and every major financial crisis is a reminder that money, at its core, is confidence, and confidence is the easiest thing to lose.